There is always risk when it comes to money. Any investment may lose money, and a cash-only position will gradually lose value due to inflation. While risk cannot be removed, it may be tailored to an individual's specific investing objectives. Asset allocation and diversification are crucial principles in calculating these risk criteria. Even if you're new to investing, you're definitely acquainted with the principles that underpin it since they've been around for thousands of years. This essay will explain what they are and how they relate to contemporary money management strategies. What exactly are asset allocation and diversification? Asset allocation and diversification are sometimes used interchangeably. They may, however, pertain to somewhat distinct elements of risk management. Asset allocation is a money management strategy that specifies how capital should be dispersed across asset classes in an investment portfolio. Diversification, on the other hand, may refer to capital allocation within certain asset groups. These techniques' principal goal is to maximize projected returns while limiting possible risk. Typically, this entails identifying the investor's investment time horizon, risk tolerance, and, in certain cases, taking into account broader economic circumstances. Simply defined, asset allocation and diversification strategies are based on the principle of not placing all of your eggs in one basket. The most effective strategy to establish a balanced portfolio is to combine asset classes and assets that are not connected. What makes these two strategies effective when used together is that risk is spread not just across asset classes but also within those asset classes. Some financial gurus feel that setting the asset allocation strategy is more significant than selecting particular products. Contemporary portfolio theory. Modern portfolio theory, MPT, is a framework that uses a mathematical model to codify these principles. It was first mentioned in a study published in 1952 by Harry Markowitz, for which he eventually got the Nobel Prize in Economics. Major asset classes tend to move in various directions. Market circumstances that cause one asset class to perform well may cause another asset class to perform badly. The fundamental idea is that if one asset class underperforms, the losses may be offset by another asset class that outperforms. MPT believes that integrating assets from uncorrelated asset classes would minimize portfolio volatility. This should improve risk-adjusted performance, implying that a portfolio with the same level of risk would provide higher returns. It also posits that if two portfolios give the same returns, any rational investor would select the lower-risk portfolio. Simply stated, MPT says that it is most effective to integrate uncorrelated assets in a portfolio. Asset class types and allocation strategies. Asset classes may be classified in the following ways under a standard asset allocation framework. Stocks, bonds, and cash are examples of traditional assets. Real estate, commodities, derivatives, insurance products, private equity, and, of course, cryptoassets are examples of alternative assets. There are two kinds of asset allocation strategies in general, both of which use the assumptions established in MPT: strategic asset allocation and tactical asset allocation. Strategic asset allocation is a classic strategy that is better suited to a passive investing style. Portfolios based on this strategy are rebalanced only if the planned allocations change due to a change in the investor's time horizon or risk profile. Tactical asset allocation suits more aggressive investing methods well. It enables investors to focus their portfolio on assets outperforming the market. It assumes that if a sector outperforms the market, it will continue to do so for a lengthy period of time. It allows for some degree of diversification since it is equally founded on the principles mentioned in MPT. It is worth mentioning that diversification does not need assets to be totally uncorrelated or negatively linked. It just needs that they are not entirely connected. Making use of asset allocation and diversification in a portfolio. Once the allocations are defined, the portfolio's performance may be tracked and assessed on a regular basis. If the allocations change, it may be time to rebalance, which entails purchasing and selling assets to restore the portfolio to its original proportions. This usually entails selling high performers and purchasing underperformers. Of course, asset selection is totally contingent on strategy and individual investing objectives. Cryptoassets are among the most dangerous asset types. Because it contains a significant amount of cryptoassets, this portfolio may be considered highly hazardous. A risk-averse investor may prefer to devote more of his or her portfolio to bonds, which are a significantly less hazardous asset type. If you want to read a detailed study report on the advantages of Bitcoin in a diversified multi-asset portfolio, check out Binance Research's Portfolio Management Series number 1, exploring the diversification benefits with Bitcoin. Diversification of a cryptocurrency portfolio. While the principles behind these strategies could theoretically apply to a cryptoasset portfolio, they should be treated with a grain of salt. The cryptocurrency market is heavily associated with Bitcoin price changes. Diversification becomes impossible as a result. How can one construct a basket of uncorrelated assets from a basket of highly linked assets? At times, particular cryptocurrencies may exhibit a lower connection with Bitcoin, which may be exploited by astute traders. However, they do not often continue as long or as consistently as comparable strategies in conventional markets. However, it can be assumed that as the market develops, a more systematic approach to diversification within a cryptoasset portfolio will become possible. Until then, the market will surely have a long way to go. Asset allocation problems. While an unquestionably effective strategy, certain asset allocation strategies may not be appropriate for all investors or portfolios. Creating a game plan is simple, but the key to a successful asset allocation strategy is execution. If the investor is unable to set aside their preconceptions, the portfolio's efficacy may suffer. Another possible issue is from the difficulty of predicting an investor's risk tolerance in advance. After a certain amount of time, the investor may discover that they desired less, or perhaps greater, risk. Final thoughts. Asset allocation and diversification are basic risk management strategies that have been used for thousands of years. They are also a key idea in current portfolio management strategies. The primary goal of developing an asset allocation strategy is to maximize projected returns while avoiding risk. Risk distribution across asset types may improve portfolio efficiency. Because markets are closely connected with Bitcoin, asset allocation strategies should be used with caution in cryptoasset portfolios. Thank you for watching.